Hi everyone, Neža here, and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. Let's dive in. Hello guys, and welcome to a new Stock Break episode. Today we will talk about Netflix. Netflix is definitely one of the hottest companies on the stock market right now. Their shares were up more than 80% in the last year, and they recently released their new earnings report, which pushed their stock even higher. It was up over 10% in one day. So I think it's worth checking if Netflix is worth the hype or not. But as always, before we start, let me just remind you that this presentation is for educational purposes only, and it should not be taken as investment advice or recommendation to buy or sell any financial instruments. So now let's get into it. Maybe some of you don't know, but Netflix actually started as DVD rental company in 1997, and they actually managed to survive the dot-com bubble and went public in 2002. But as technology developed, they adapted to those changes and they entered streaming in 2007. Then a few years later, they even started producing their own content, like maybe you still remember some of the hits like House of Cards or Orange is the New Black. But competition in streaming world intensified and they face those pressures. They also face challenges like people sharing the passwords. Maybe also some of you did, at least I did. And we can clearly see those ups and downs on their stock chart. We can see this massive drop in late 2021 and 2022. But then we can also see an impressive rebound. If you're listening to this episode on a podcast, just imagine more than 400% growth in the last 2 years. And recent earnings that were released about a week ago impressed the market even more. If we look at some of the highlights, they managed to expand their operating margin to 27%. But what really impressed the market and sent the stock over 10% higher after earnings release were subscription numbers, because they managed to add 19 million new subscriptions to the platform. And the market expected only 9 million to be added. So with that, they managed to surpass 300 million paid memberships. And even when looking ahead, they raised 2025 revenue and they said that they will focus on expanding their content library, live events, and advertising business. So with all of this success and stock soaring in the last 2 years, I think it's logical to ask if this growth is sustainable in the near future or not. If we want to answer this question, though, we have to understand Netflix's business model and cover some of the fundamentals. Their business model is actually quite simple because the company makes money primarily through subscriptions. But it is worth noting that it is no longer just about monthly fees. Here on this chart, we can see their total subscriber growth from 2017 until 2024, and we can see this surge in subscriber numbers. But this surge is not driven just by successful content or crackdown of password. It is also driven by the success of their ad-supported plan. Their ad-supported plan makes Netflix more affordable, and actually since launching it in 2022, more than 50% of new subscribers decided to opt in for this cheaper ad-supported version. So this is also reflecting in their ad revenue, because their ad revenue actually doubled in 2024 and it is expected to double again in 2025 because basically brands are trying to reach massive audience. And what is a better place to be than streaming service with more than 300 million subscribers? And with that, advertising is shaping up to be a high margin growth engine for Netflix. Now, talking about margins, we can see how drastically their margins improved over the past few years from this chart. Because here we have gross margin, operating margin, and net margin presented on one chart. And if we take a look at operating margin, for example, that is presented in green, we can see that their operating margin was standing at about 13 in 2019. And fast forward to today, it more than doubled. Now it is standing at about 27%. And there are projections that it will hit 29% in 2025. And what is the reason behind that, you may ask? The reason is that Netflix is spreading their fixed costs over larger subscriber base. So as long as they manage to keep growing their revenue while keeping their costs in check, Netflix margins could expand even further. We covered some of their fundamentals and we explored how their business model works. I think it's time to check their valuation. Stock is currently trading at about $978 per share, but that doesn't tell us anything. We have to check some valuation metrics. If we look at P/E ratio, it is standing at 49 at the moment, and their forward P/E ratio at 39, and both of those numbers are at the higher side of their historical range. Other valuation metrics, price to sales, for example, price to sales is at 10 right now, and EV to EBITDA at about 16. Also, those numbers suggest that Netflix might be trading at the premium right now. Even if we compare their valuation metrics to some of their competitors like Disney, for example, we can see that competitors are trading at a bit lower multiples right now. And with that, Netflix seems a bit pricey. Even Guru Focus valuation, Guru Focus suggests that the company is currently significantly overvalued. That said, even if the company looks overvalued at the moment, there are some strong points that Netflix can offer investors. For example, their return on equity is currently standing at 39%, which is way above their rivals. Besides that, we mentioned some of their strong points like their growing margins and adapting and adding ad-supported model to their platform, which seems to be very successful. But in the short term, the stock might look expensive because it is up more than 80% in the last year. And there are some concerns around business. Every business faces some of the risks. And here the fear is that their subscribers' growth might slow down and that their costs for creating content are just rising. Besides that, unlike many of their competitors, Netflix hasn't expanded much beyond streaming. And those are the factors that could limit their potential future growth. Besides that, if competition ramps up, or if their growth slows down, this high valuation might not be able to hold up that well. I would say that on the long run, Netflix is definitely a great business, and they showed us how they can adapt constantly to the changing industry. But at those levels, I would think twice before entering. That's it for Netflix. Let me know what you think about the company in the comments. And don't forget to like, share, and subscribe if you enjoyed this episode. Also, let me know which company would you like to see in the next stock break. See you next time.